Hello and also hello. This week can only be summed up in one word: huge. A huge week of earnings, a huge week of data, and that's going to bring huge market swings. So today, I'm going to bring some facts in a time when things can get crazy. We're going to be talking about earnings, why non-farm payrolls are likely to beat expectations, seasonality tailwinds, and one huge risk to this market. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks climbed on Monday to kick off a pivotal week packed with big tech earnings, an inflation update, and a crucial monthly jobs report. We saw broad-based gains across the board, led by financials, but weighed back by Nvidia, Microsoft, and the overall infrastructure and semiconductor space. We also saw massive underperformance in energy stocks, and this is on the back of some geopolitical news. Israel did launch some missiles on Iran. However, they did not attack critical infrastructure, meaning that the energy supply chain from Iran's side is still intact, and that's why we saw crude down 6% today. The market was actually anticipating more war, which is crazy to me. Nonetheless, that weighed on the overall market, but we saw a bullish day across the board. Apple gained, Google, Meta, Amazon too. Tesla was down 2.2%, but that's just some profit taking after a 23% gain last week. And all in all, what we really saw today was underperformance in some of the defensive names like healthcare, staples, and outperformance in just cyclical assets. We also saw a bunch of stocks running up into their earnings, one of them being a stock that I own, PayPal, up 2.24%. It's also up about another 1% in the extended hours. Big expectations here for the stock. We'll see if management can meet them. However, the market is expecting about $1 in earnings, maybe a little bit more. I'm expecting $1.13. I'm expecting a huge beat this quarter, and a lot of their earnings is going to be led by their marketing campaign as well as their PayPal venture division. There's been a lot of things going on in the venture division, and I think that's going to contribute to overall earnings. And I think we're going to see a very nice upside surprise. Another stock that I own, Paycom Holdings, up 1.71%. It reports its earnings on Wednesday. By the way, PayPal reports tomorrow before the bell. Paycom was up 1.71%, very similar to PayPal, just running up into its earnings. However, we did see some massive earnings declines today. Transmedics Group, this is a very popular stock on Twitter, down 25%. It actually maintained its guidance and reported inline revenue. However, earnings was a shocker because it had to service a lot of its planes, and I think the market is coming to realize that this is a healthcare company, but it's also somewhat of an industrial. It owns a massive plane fleet that it needs to service and upgrade on a year-over-year basis, and the market is just doing a simple re-rating for that valuation. But going back to the market overall, looking at sectors, we saw an XLE. They weighed on the market today. Tech was pretty much flat, down 0.01%. Energy stocks down 0.65%, and that meant the S&P 500 was only gained 0.28%. If we saw more participation in technology names, this would have been higher. However, we have to look at things objectively, and we did see massive outperformance in financials, up 1.2%, absolutely outperforming the broader market, and even second place, which was materials, up 0.85%, and utilities 0.78%. A very bullish day across the board, but more so in small caps. Small caps were the real outperformer. Value, core, and growth outperformed the mid caps and large cap size segment across all of the factor segments, and it was a very bullish day for small caps. And with small caps outperforming today, despite what happened with rates, I think the market is really positioning themselves for a massive Q4 outperformance in small caps, and I do think we're going to see small caps outperform. Nonetheless, bullish day across the board except in large growth. That was only up 0.01% today, virtually flat. But if you were positioned in anything else today, you had a very green portfolio. Even international stocks gained, excluding some components of Southeast Asia and some parts of Europe. We saw bullish momentum in North America, South America, India, China, most of Asia, Japan as well, Australia and New Zealand. It was a very, very bullish day across the board. Even here in Europe, largely bullish, very, very strong market gain gains across the board, and that's why market breadth improved significantly. We saw the 5-day and 20 moving day averages retake their 50% after last week's decline, and these shorter term averages tend to be very, very noisy. That's why we always compare it with the medium term and longer term trends, and we said that despite the noise we're seeing right here, you want to buy the dips because the longer term averages are intact, and now we're seeing fruits of that labor. The 5-day and 20-day averages back above the 20% mark. And look at this huge move up from Friday, from 33.41% stocks above their 5-day to nearly 64% of stocks, and we should see this move into the 20-day, into the rest of the week, assuming everything goes according to plan, and that is earnings come in line and the data comes in line. If we see beats, we could actually see significant upward momentum. But guys, look at this, the 100-day and 150-day moving average, 61, nearly 62% and 61% respectively. Guys, this is very, very strong momentum we're seeing at market breadth, and you don't want to fight the trend. And the trend is up. You can see year to date, we continue to move higher, and the S&P 500 continues to trade at its all-time highs. Despite everything we actually saw in the market today, yields did gain. Now, it doesn't really show it right, but if you actually look at the 10-year yield, this is just the after hours price. The 10-year yield did gain 0.99% today. So we did see a move up in yields. The 30-year yield also did gain 0.64% today. And the after hours, we're seeing a little bit of downbeat action, although inconsequential really. The dollar remained virtually flat, and despite a move up in yields and a flat dollar, small caps outperformed. And that just goes to show maybe the fundamental picture we're seeing. Right now, small cap earnings are reporting about 40% year-over-year earnings growth. Market expectation going into this earnings season was about 32%. So we're seeing a huge beat, but particularly in revenue. Revenue was supposed to come in at 0.5%. Russell 2000 companies are now reporting 1% revenue growth. It doesn't look like much, but that's a huge 100% upside surprise we're seeing. And that's why we're seeing a lot of resiliency in stuff like the IWM, which is the Russell 2000. Guys, we put in a low right here and a higher low, and now we're forming another higher low after a huge day that's up 1.63%. Now we do have to go retake these 52-week highs to confirm this low, but things are looking very, very constructive for the IWM and looking very constructive for a Q4 rally. If we actually just go to the RTY, we actually retook the gamma flip. We're backing positive gamma, and the gamma flip moved up. So we moved up, retook a higher gamma flip. The put support moved up as well today in the RTY. Now, one thing that did happen was the core resistance did move down. However, that just means we're seeing a bit of volatility compression, and when that volatility expands, we normally see a huge upside move, and based on the technical indicators we're seeing, that move is going to be to the upside. We just need to retake these highs, and then it's off to the races for small caps. And the RTY, the Russell 2000, bodes well for all small cap quality, small cap cash cows, everything in between. Looking at the S&P 500, not much to say. The gamma chart has not moved. We're in the middle of gamma flip and core resistance, so we just buy dips, sell rips. If we do get a move to the 57.75 area, you do want to buy those dips, but very constructive price action, trading at all-time highs here for the S&P 500. Not much to say, not much to do, guys. All you really want to do is just buy dips when you do get the opportunity. Looking at the Nasdaq 100, we did see constructive price action like the IWM. We actually saw the gamma flip move up 100 points, same with the put support, and the core resistance stayed exactly where it is, which is pretty much at the all-time highs of 20,675. And guys, if we do get a pullback here to the 20,200 area, do you think you want to buy those dips? Because the expectations for this earnings season for tech are not as high as the first and second quarter, and that does lend itself to outperformance if we do beat. And I do think we are going to go ahead and retake these all-time highs this week. We just need Microsoft and Nvidia to participate in this tech rally, and then we should see new all-time highs in the Nasdaq 100. If we can go do that this week, that bodes very well for the rest of the quarter, because momentum brings momentum. And if we do get some of the tailwinds that I do think we're going to see in the market, we're just waiting for them to happen. I think we are going to see rates come down, and when that happens, that's also going to bring the dollar down with it. When yields fall and the dollar falls, that is just less competition for stocks in terms of yields. The cost of capital is lower. That's better for earnings, and that is just a tailwind for stocks in general, for small caps, for large caps, for mid caps. And we just have to wait for that to happen.
I do think it's going to happen. I think we're going to see yields move down, and I think it's going to come after the election. We did see 70 basis points worth of a move to the upside after the Fed did their 50 basis point rate cut right here, and I do think we're due for a little bit of a pullback in yields, but we'll see where that ends up. Looking at commodities, gold was down 0.17% today. Same with silver. Crude was down 6%, a huge move after what we spoke about earlier in the video. But guys, all in all, equities right now look very, very healthy, look very, very strong. You don't want to fight the trend. We're in the most bullish time period of the year where stocks are adding $6 billion worth of buybacks every single day into the market. We're exiting the buyback blackout period. Earnings are here. We're looking at a robust macro backdrop. Everything is sort of coming together. Don't really want to fight the trend. The path of least resistance is higher, and that means buy dips at the 57.75 for the S&P 500, the 20,200 for the Nasdaq 100, the RTY, it's the 2240 level where we are right now. So the RTY, I mean buying here, you're looking at a very good setup into the end of the year. And then the RSP, I think the 176 area, if we do get there, buy that dip, because I do think we're going to go to the 200 level into 2025. So equities looking poised to go higher, guys. You don't want to fight this trend. Buy dips, sell rips. And looking at sentiment, this is Goldman Sachs Sentiment Indicator, which just tracks positioning of retail, institutional, and foreign investors over the last 12 months. And sentiment above the zero line means that those investors are holding more equities than they did last year as a percentage of total value. Below the line means they're holding less. Even though we have seen sentiment pull back in recent months, still seeing a 0.5% print means that the overall sentiment is still largely bullish, although not euphoric like it was for most of this year when sentiment was very, very stretched. And even though we have seen a bit of a pullback in recent months, we've seen a bit of a bottoming process happen here. And this is what you want in a bull market, because this does provide opportunity, but this is also telling us that there's a bit of angst that these investors are seeing. And that generally happens when you have rising yields, a rising dollar, and rising gold prices, as well as the geopolitical stuff that's going on. Nonetheless, sentiment is still bullish, heading into what is an extremely bullish period this time of the year. From October 27th to January 27th tends to be very, very bullish. And this 3-month period right here is the most bullish period of a trailing 12-month period, especially when we've had returns greater than 10% in the last 12 months. Average returns from October 27th to January 27th is 5.675%. Look at the median returns, 7.23%, 23 wins, 4 losses. So you want to be long in this environment, and we see very linear returns. Look at October to November, November to December, December to January. We see 3%, 2.2%, and 3.8% returns. So we have very linear returns, very bullish returns, historically speaking, over the next 3 months. And you want to be long, you want to be exposed to equities. And this is what it looks like on a chart. This is where we are in October 27th. Guys, from here, it's literally up, up, and away. We have seasonal tailwinds. I think we're also going to see tailwinds with the yields and the dollar. I think those are going to pull back. That's going to further help support equities. And something else that's going to support equities is buyback authorizations. Companies between November and December have the scope to add $6 billion in share buybacks after the buyback blackout window ends. And this would represent 21% of total buybacks into the end of the year. And we should see $988 billion worth of buybacks for the year. And this is liquidity coming into the market. And this is also in a time of the year where we have shortened trading weeks. We have Christmas, Thanksgiving, New Year's, shortened trading days. This is time periods of the year where we have a lot of liquidity to get through. These investment managers need to make their investments for the next year, and there's less trading days to do it. And that's generally why we see an end of year rally, and all of these tailwinds are going to come together. And I do think we're going to see a bullish end of year run. And the reason why this year has been bullish simply has to do with earnings. Realized earnings has been very, very strong this year, and the expectation is for it to continue. And when market expectation expects earnings to be higher than what they are in the next 12 months, stocks will rally. Looking at the year and now in earnings as well, guys, even though we have reported only about 4.4% in earnings growth, one-day stock reactions have been very, very positive. And that tends to happen when you do have less expectations for earnings coming into this earnings earnings season, EPS and revenue beats are seeing a one-day stock reaction of 3.15% versus the average of 1.49%. That is bullish, and if we do get major beats in the tech names this week, we could definitely see the Nasdaq 100, the S&P 500 take out new all-time highs. So be prepared for volatility to the upside and downside. Guys, looking at the macro, this is the Fed's GDP now sitting at 3.2%. We saw a little bit of a downtick, nonetheless still robust. Anything above 3% is just really solid growth and solid economic expansion. We like to see that. And looking at the historical relationship, a 3.2% GDP now bodes very well for the NFP print this Friday. With the Fed's GDP now at 3.2%, looking at the historical relationship, it suggests a Q3 average NFP could come in at 240. That is absolutely huge because the current consensus expectation is for 140k. So we might see a huge beat based on this data print right here. However, do take it with a grain of salt. This data set tends to be very, very noisy and the relationship isn't that strong. Nonetheless, if we do see a huge beat, that's going to bode well for the overall economy, but the markets could react differently because it probably means higher yields, higher dollar, but we'll see how that pans out. Nonetheless, backdrop overall is a stronger economy. Let's switch gears, talk about the election, and as of October 24th, the most likely scenario right now for the US election is actually a Trump sweep sitting at 34% odds, Trump and split Congress sitting at 32% odds, meaning that the markets right now are pricing in a Trump executive branch victory and maybe split Congress and sweep on the ropes with 50-50 odds. Harris split Congress and Harris sweep sitting at 22% and 11% respectively. There's a 66% probability as of right now of a Trump victory and or split Congress or sweep. So, and that's why we have seen the Trump trades really outperform in recent weeks, but we'll see how this evolves as we get closer to the election. Looking at earnings this week, guys, we have a very, very big week. We had a big day today and it's only Monday. Tomorrow, we have SoFi, PayPal, BP, McDonald's, Pfizer, Royal Caribbean Group, JetBlue, Crocs. Just to kick things off, after the close, we have AMD, Alphabet, Snapchat, Chipotle, Visa, First Solar, Reddit, Chubb Insurance Group, and then it just gets crazy on Wednesday and Thursday, but we'll tackle those days as they come. But we also have a huge week of data. Some of the big reports only start on Wednesday. However, we have JOLTS as well as the GDP growth rate. The expectation there is for 8.04 million. The forecast there is for 7.8 million and the GDP growth rate at 3.3%. The Atlanta Fed's GDP now is tracking at 3.2%. So the consensus forecast and the Atlanta Fed's forecast, rightly so, sitting at about the same. That's exactly what you want to see. And then we also have income. We also have the income outlays on Thursday and then the big NFP and the unemployment rate on Friday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Cheers.